Yeah, what's up guys, welcome to this section where we are going to be discussing the next thing in this our build up, which is the liquidity sweep. So by now I believe we have trashed everything related to market structure based on this strategy. We started with the basic market structure to the advanced market structure. We also discussed the algo market structure and see some chart examples of this particular market structure. Okay, so based on our a list right here, the next thing we are supposed to be discussing, or we are going to be doing, is the liquidity sweep. That's the important concept. It's another important concept of this strategy. You must understand this. All right, so and you will also see how it's connecting, how these things are connecting. So the first thing we are looking at right here is liquidity. Okay, so first let's just read a little bit. No, I don't like all this theoretical stuff, but we can actually, you can read up a lot about liquidity on your own. But simply, liquidity describes the degree in which an asset can be quickly bought or sold in the price, okay, at a price reflecting its intrinsic value. Okay, so we are talking about the easiness of purchasing a particular commodity, or the price level where an asset can easily be bought or sold, right? So simply when you are targeting to buy a particular commodity, you want to make sure that the price is down, right? You want to make sure that the price is low so that you can afford to purchase that particular commodity. So let me share with you a typical example of understanding liquidity. Sorry about this. Okay, sorry, I think my network is slow. So let me share with you a clear example what we mean by liquidity. Okay, now if the price here, so we are going to use this for example. I think I have to do something so that you can see everything clearly. Okay, so if you look here by the right hand side, you can see price level. So this is 2200, we have 2180, we have 2600, sorry, 2160 and all that. Okay, so if a particular commodity, let's say this is a phone, okay, so this phone at a particular time, this phone is sold, let's say the phone is sold at 180, okay, let's say, or let's say the phone is sold at 2000. So let me just use this. I just want you to understand this liquidity concept. Okay, so let's say the phone coordinates, I put in 2000, sorry, 2000 should be somewhere down. Okay, here. So this phone is sold at 2000 at a particular point in time. Okay, now if you maybe after 2 weeks or a month you went back to the market, and now you are now hearing that this phone have moved from 2000 to, let's say, 2100. Okay, let's say 2100. Okay, 2100. So now, can you now easily buy this phone at this price? The answer is no, because you saw the phone at 2000. Now you are coming back, you have picked up your money, you want to go and purchase the phone, and the phone is being sold now at 2100. It's now more higher than the price you budgeted, right? So that means you have to go back again. You have to go back and try and make sure you have up to 2100. Now going back, the next market day that you are coming back, the phone is now sold at 2120. Okay, so the phone is now sold at 2120. So can you still purchase this phone? No. If you are purchasing, it's not going to be easy for you to purchase this phone at this price, right? Because the price is going higher and higher and higher. So what if after you decided to relax, after 3 months you now come back, and when you are coming back into the market, you are now seeing that this phone is sold at 1900. Remember, you have been in the market before and the phone is sold at 2400, from 2000, 2100 to 2120. Now you are coming back after 3 months. Now the phone is sold at 1900, which is here now. Okay, so can you easily buy this particular phone? The answer is yes, because you saved up 2000, you enter the market, is now 2100, you move back, saved up again up to 2100, coming back again is now 2120. Then you relax, you keep your money until 3 months, you are coming back and it's being sold at 1900. That means you can easily buy this phone and you still have change left in your pocket. So at this particular price right here, this particular phone, okay, this phone right here is liquid at this particular time, this price, at this price. Okay, that's exactly what liquidity mean. A particular price or price level where you can easily buy a particular commodity, okay, or sell a particular commodity. So we are talking about buying here. So the opposite, the reverse, is when you are selling. Okay, so this phone is easier to buy at this price than buying it above here, any price above this level, right? So anything below here is liquid. Okay, anything above here is not going to be easy for you to purchase, right? So that's exactly what liquidity means. So I will share with you a sketch, okay, of how we identify this liquidity, okay, in the chart. All right, guys, so we are going to be looking at different ways in which we can identify liquidity, all right, or liquidity zone. Now the most simplest one, or the common one, is when the price is ranging in between a bound. Okay, so when the price is doing this, we already know from here, we know that liquidity is resting above here and liquidity is also resting below here. All right, so the price is likely going to break out of this level at a particular point in time, right? So this is another way. So here we have liquidity at this zone, at this level. We also have liquidity around here. Okay, so these are the liquidity zone based on this particular price action. Okay, so another way to identify this is when the price is trending. Let's say the price is pushing up this way. So if the price is pushing up this way, or let's say the price is pushing down also, so liquidity are resting below here. We have liquidity here, here, here. So these are the points where liquidity are resting. For a downtrending market, we are having liquidities around this area. Okay, so we want the price to always come to this zone. Okay, so this price right here cannot be easily bought at this point. You cannot buy this easily, but if the price should retrace back a bit down to this level, you can easily buy this market here now than here. So even with the stop loss or your risk management, when you place a trade up here and you are buying and the price started to retrace back a bit, and when you place here and the price retrace and start buying, you know you are going to make more money from here than when you enter here, right? So you can easily buy this particular commodity or currency pair or indices, anything like that, right here than when you are buying above here. So liquidity is resting here, so liquidity is also resting here, is also resting here, is also resting here. So this is the easiness of purchasing this particular commodity around this zone. You can easily purchase here, 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 here than purchasing above this level. All right, you cannot be doing this right here, rather you want to be doing it below here. Okay, so that's for an uptrending market. So for a downtrending market, liquidity is resting above here. Okay, these are liquidity levels. So you want to see the price retrace back to this level or this level or this level. You want to see the price around here. Okay, you want to see the price around here. So you don't want to start selling at the low, you should be looking at selling at the high. Okay, so that's it. You want the price to be high before you sell for you to make money. Okay, so liquidity around here. So this is typically how to identify liquidity in an all-traded market, right? So we have seen how to do that in a ranging market. We have also seen how to do that in a trending market. So simply the next thing we are looking at, because what our concept is not just about liquidity, but we want a liquidity sweep. Okay, liquidity sweep. So when you have a particular market trending this way, so we all agree that there are liquidities below here, here. Based on what we explained, we had liquidities around here. So, and our concept is liquidity sweep. So we want to see the price not just coming back towards this zone or at this zone, but we want the price to go a little bit below here. That is sweeping. The price should sweep that level. Okay, so if the price is here, we are not doing anything. We want the price to first sweep that particular level. The price should go below a particular liquidity zone. So when the price get to this zone, okay, you can see the price move below here. So this is exactly what is known as liquidity sweep. So the price move below this level of liquidity. Okay, so here we can call this sweep of liquidity, guys. Okay, I can just say maybe SL. So this can be seen as sweep of liquidity around here. So you can use the money sign, dollar sign, anything you want. It's not important. What is important is that you understand the concept. Okay, so this is actually a liquidity sweep. So what if the price push all the way to this level and did the same thing? We also have a sweep of liquidity around that zone. Okay, we can still call this sweep of liquidity. All right, so once liquidity level is swept, we are looking for a reversal. So now what is important is that you understand this concept. Okay, forget about how we are going to be using it, anything like that. Just understand this concept of liquidity sweep. So you want to see a sweep of liquidity. If you want to see the price break a particular level, what I mean by break it is just going below it. Okay, so we want to see it sweep liquidity with a wick. Okay, most time, but if it must be the body, it should not be more than 1 or 2 candles, right? So that is exactly for an uptrending market. The reverse is the case in a downtrending market, which I can equally share with you guys quickly. All right, so this here is a downtrending example. So at this point we have our liquidity resting above here, okay, sorry about that. So we have our liquidity resting above the zone. So this is too big. So we simply want to see the price bouncing back to this level, okay, and not just this level, but should go a little bit above it, okay, or a little bit above this one. All right, if you look right here, we also have a sweep of liquidity right here. Okay, have a sweep of liquidity right there. You can see this one is just like sweeping with the wick. Okay, so very important, guys, very important. So that's exactly what sweep of liquidity means. So let me clearly share with you another way to identify this. I want to make sure you understand, because this is the major thing. Once you understand market structure and you understand liquidity, you are good to go with this strategy. So let's say that the price is dropping. Let me also share it this way. The price is dropping and dropping, let's say this way. At a particular point in time, you know the price will not continue pushing to the downside. The price will tend to pull back a bit. Okay, so you can have this kind of pullback, and the price continues the move toward the downward side after the pullback. So at a point, the price will also retrace again. Then you might have the price also drop. So now if you look right here, you will agree with me that this zone is our liquidity zone. We have also liquidity resting here also. So let's say that the price decided to do this, there's start pushing up again from here. The price started pushing up, and instead of maintaining the sequence, the price started to do this. You know, I'm not adding the wicks, you should know already. I'm not actually adding wicks, but let me just add it here. The price do this at this point. Now if you look at that price, the price actually swept liquidity right there. It can happen with the body. The price can sweep liquidity with body or the wick. Okay, but we want it to be mostly the wick. Okay, we want to see the wick, but it can happen just with the body of the candle, right, closing below it. For me, most of those things are not break of structure, but the common thing we hear out there is break of structure. So the price can sweep liquidity with the wick or the body, but we want it to always do that with the wick. Okay, when we see it with the wick, we are more comfortable than the body. Okay, but when it closes with the body, once it's not more than 2 candlesticks, we are good to go. In fact, we just want it to be just 1 candle, okay, closing above that particular level, or the wick. We want to see the wick above the level. Okay, the high of the candle should be above the previous swing. So when we see this is exactly what sweep of liquidity look like in a price action in a chart. Okay, so this is our liquidity sweep right there. Okay, this is our liquidity sweep. So this is a downtrending example. So let's see an uptrending example. So if the price is pushing up this way from here, then at a time the price will drop a bit, then the price continues the up move towards the upward direction this way. The price retraces back again. Now you might have another push towards the upward side. The price retraces. Okay, so I'm doing this just to, you know, make you understand this particular concept, because that's the major thing we are doing here. We want to see the manipulations, those sweep of liquidity stuff, before we start thinking of our setup. Okay, so this is have a week again. So at this point we are having another sweep of liquidity, but this is now an uptrending example, guys. Okay, so we still have our sweep of liquidity right here. Okay, but this is an uptrending example. Then there's something I want you to also pay close attention to. Can you see that before that sweep of liquidity, okay, the price have been breaking structures towards the downside? So break of structure towards the downside is important in a downtrending market. Okay, in a downtrending market, break of structure towards the downside is very important, right? You can see the price breaking structure before the sweep of liquidity. Then in our trading market, you can see also that the price breaking structures towards the upward side. Okay, you can see another break of structure right there. You can see another one. Okay, right here. So the price is breaking structure towards the upward side. You now have your sweep of liquidity. Then our setup is building up. Remember, we need to see first, we need to see a particular structure, which is the algo market structure. And what is this structure called? If you follow this lesson step by step, this is already an algo market structure. So there is no liquidity without algo market structure, and there is no algo market structure without sweep of liquidity. So this is how this concept is connecting now. Can you see how the concept is connecting? So you must understand these things. That's why I have to start with the structure coming down to liquidity. So all of them works hand in hand. Okay, so you can see this high have been invalidated based on our algo market structure. This is not double top. Okay, this is a clear sweep of liquidity right here. Okay, or clear violation of this high. So this is it. This is clearly what liquidity look like. Okay, sweep of liquidity. Okay, and that is the second concept of this strategy. So we are going to be looking at the next concept, which based on our list right there. Okay, we are going to be looking at the premium and discount. We are going to be looking at the order block. We are going to be looking at the fair value gap and also candlesticks. Okay, so this is it for this video. I hope this is helpful. I will see you guys in the next one.